A leveraged buyout LBO is like buying a house with a small down payment and a big mortgage. The down payment is the equity contributed by the private equity PE sponsor, while the mortgage is the debt stack that finances the rest of the purchase price. Equity, cash that the sponsor puts in, often 10 to 30% of total price. It behaves like the homeowner's cash down payment. It absorbs the first loss but also captures the upside. Senior debt, the most secure loan, analogous to a first mortgage. It has the lowest interest rate because lenders are first in line to be paid if the company defaults. It is usually amortizing, principal paid each year, and may include a covenant that caps leverage. For example, debt/EBITDA less than or equal to 4.0x. Subdebt or subordinated debt sits behind senior debt like a second mortgage. It carries a higher interest rate because lenders are riskier. It often has interest-only payments and a longer maturity. Mezzanine, a hybrid of debt and equity, similar to a home equity line of credit. It may pay a cash coupon plus an equity kicker, for example warrants. It fills the gap between the amount senior or sub-debt can raise and the equity the sponsor wants to invest. Vendor-seller financing, the seller agrees to be paid over time, like a friend lending you money to buy a car. It is usually cheap, low interest because the seller wants to close the deal. All these pieces together form the capital structure of an LBO, and the sponsor's goal is to choose a mix that minimizes cost of capital while staying within covenant limits. Explanation: the operating model is the bread and butter of an LBO. It predicts cash that will be used to pay down debt. Revenue start with historical sales, then apply a growth rate, e.g. 5% year over year. Think of it as planting a garden. The size of the garden each year depends on how fast the seeds market grow. EBITDA earnings before interest, taxes, depreciation, and amortization. EBITDA equals revenue times EBITDA margin. The margin can be assumed constant or modeled to improve with economies of scale, e.g. margin rises from 15% to 18% over 5 years. Working capital cash tied up in day-to-day operations. The most common rule is to express it as a percent of revenue, e.g. 10%. Delta WC equals WC percent times revenue this year minus WC percent times revenue last year. Positive delta WC means cash is used, negative means cash is released. CapEx capital expenditures needed to maintain or grow the business. It can be a fixed dollar amount or a percent of revenue. Free cash flow FCF equals EBITDA minus taxes minus delta WC minus CapEx minus depreciation. In an LBO, we usually add back depreciation non-cash to get cash available for debt service. The model is built year by year, usually 5 to 7 years, and feeds directly into the debt schedule. Explanation: the debt schedule tracks how much debt remains each year and how much interest is paid. Amortization for senior term loans, a portion of principal is repaid each year. Principal repayment equals beginning debt minus ending debt divided by remaining years. This is similar to paying down a car loan. Each payment reduces the balance. Interest expense calculated on the outstanding balance at the beginning of the period. Interest equals beginning debt times interest rate. If the loan has a floating rate, the rate may be linked to LIBOR plus spread. Cash sweep after meeting operating cash needs, any excess cash is forced to reduce debt. Sweep amount equals the maximum of zero and free cash flow minus minimum cash balance. This is like using extra savings to pay off a mortgage early. Covenants financial tests that must stay within limits such as leverage covenant: debt over EBITDA less than or equal to 4 times senior debt. Interest coverage: EBITDA over interest greater than or equal to 2.5 times. If a covenant is breached, the model must flag it and may require restructuring, for example higher interest or forced repayment. The schedule repeats each year. Start with opening balance, add new borrowings, if any, subtract amortization and cash sweep, calculate interest, and end with closing balance. The final closing balance at exit should be close to zero or a small rollover balance. Private equity investors care about how much money they make on their equity contribution. 2 core metrics are used. Internal rate of return, abbreviated IRR, the discount rate that makes the net present value (NPV) of equity cash flows zero. 0 equals sum from T equals 0 to N of equity CF sub T, divided by 1 plus IRR to the T, where equity CF0 is the negative equity outflow, the purchase price, and later equity CF sub T are cash flows received, interest after tax, dividends, and final equity proceeds. Think of IRR as the average yearly profit on the money you put in, accounting for timing. Cash-on-cash multiple, abbreviated MOM, the simple ratio of total cash returned to cash invested. MOM equals sum from T equals 1 to N of equity CF sub T, divided by absolute value of equity CF0. It does not consider timing, so a 2.0 times MOM could be a 10% IRR over 10 years or a 50% IRR over 2 years. Equity value waterfall shows how equity value is allocated at exit. Return of capital first, the equity investors get back what they originally put in. Preferred return, if any, some deals promise a hurdle, for example, 8% preferred. Catch-up and carried interest, remaining profit is split, commonly 80-20 between investors and the sponsor. The waterfall is useful for negotiating sponsor fees and for modeling founder rollovers. The exit is the final chapter of an LBO. The PE firm sells the company and cashes out. 2 common ways to estimate exit value. EBITDA, a multiple method. Apply a market-derived multiple to the projected EBITDA at exit year. Enterprise value exit equals EBITDA, a exit times exit multiple. The multiple is often based on comparable public companies or precedent transactions, for example, 8.0 times. Discounted cash flow method, forecast free cash flow beyond the explicit projection period, and discount it back at the firm's weighted average cost of capital, WACC. Terminal value DCF equals free cash flow N plus 1 divided by WACC minus G, where G is a modest perpetual growth rate, 2 to 3%. Then discount the terminal value to present value using the same discount rate used for cash flows. Timing scenarios, the model usually runs 4 to 7 years. Changing the exit year changes both the EBITDA, more growth, and the number of years for cash sweep, more debt paid down. A later exit may increase value, but also lower IRR because cash is tied up longer. Both methods are often run side by side. The higher of the two is taken as the exit value, a conservative approach. Sensitivity analysis tests how the IRR and MOM change when key inputs move. Leverage ratio, debt over EBITDA. A higher leverage increases equity upside because less equity is required, but also raises interest expense and covenant risk. Example, vary senior debt from 3.0 times to 5.0 times EBITDA and observe IRR swing. Exit multiple. Because the exit value is a multiple of EBITDA, a 1.0 times change, for example 7 times to 8 times, can shift the equity proceeds dramatically. Growth rate, adjust the revenue growth assumption, for example plus or minus 1%. Faster growth boosts EBITDA, improves cash flow for debt repayment, and lifts exit value. Cost of capital WACC in a DCF exit. A higher WACC reduces the terminal value, lowering MOM and IRR. Scenario modeling. Build separate base, upside, and downside cases that combine several input changes. For example, high growth plus high multiple equals upside. The output is a table or tornado chart showing IRR and MOM under each scenario, helping investors understand risk/return trade-offs. Assumptions. Purchase price enterprise value $500 million. Capital structure equity sponsor $100 million, 20% senior debt $300 million, 60% at 5% interest. 5-year amortizing sub-debt $80 million, 10% at 8% interest. Only mezzanine $20 million, 4% at 12% interest. Only vendor note 0 not used. Operating projections, 5-year revenue year 0 $200 million, growth 5% per year, EBITDA margin 18% constant tax, rate 25% capital expenditures $8 million per year, working capital 10% of revenue. Exit after year 5 at EBITDA multiple 8 times. Minimum cash balance $5 million cash sweep. Step 1 project operating numbers. Year 0 revenue $200 million, EBITDA $36 million, taxes $9 million change. In working capital 0 capital expenditures $8 million free cash flow, not applicable used for purchase. Year 1 revenue $210 million, EBITDA $37.8 million, taxes $9.45 million change. In working capital plus $1 million capital expenditures $8 million free cash flow $19.35 million. Year 2 revenue $220.5 million, EBITDA $39.7 million, taxes $9.93 million change. In working capital plus $1.05 million capital expenditures $8 million free cash flow $20.72 million. Year 3 revenue $231.5 million, EBITDA $41.7 million, taxes $10.43 million change. In working capital plus $1.10 million capital expenditures $8 million free cash flow $22.14 million. Year 4 revenue $243.1 million, EBITDA $43.8 million, taxes $10.95 million change. In working capital plus $1.16 million capital expenditures $8 million free cash flow $23.69 million. Year 5 revenue $255.3 million, EBITDA $45.9 million, taxes $11.48 million change. In working capital plus $1.22 million capital expenditures $8 million free cash flow $25.24 million. Step 2 debt schedule only senior debt amortizes other debt is interest only. Senior debt amortization $300 million divided by 5 equals $60 million per year. Cash sweep after meeting a $5 million cash floor, any remaining free cash flow reduces senior debt further. Year 0 beginning senior debt $300 million interest, 5% $12.5 million principal amortization, $60 million sweep 0, ending senior debt $240 million. Year 1 beginning senior debt $240 million interest, 5% $12 million principal amortization, $60 million sweep $2.35 million, ending senior debt $175.65 million. Year 2 beginning senior debt $175.65 million interest, 5% $8.78 million principal amortization, $60 million sweep $5.94 million, ending senior debt $98.91 million. Year 3 beginning senior debt $98.91 million interest, 5% $4.95 million principal amortization, $60 million sweep $11.23 million, ending senior debt $27.68 million. Year 4 beginning senior debt $27.68 million interest, 5% $1.38 million principal amortization, $60 million capped sweep $17.38 million, ending senior debt 0. Year 5 senior debt 0 interest, 0 principal amortization, 0 sweep 0, ending senior debt 0. Interest on sub-debt and mezzanine interest, only each year sub-debt interest, $80 million times 8% equals $6.4 million per year. Mezzanine interest, $20 million times 12% equals $2.4 million per year. Step 3 equity cash flows. Equity outflow at acquisition minus $100 million. Each year equity receives any cash left after paying all debt interest senior sub-debt mezzanine and maintaining the $5 million cash floor. Year 1 senior interest $12 million sub-debt interest, $6.4 million mezzanine interest, $2.4 million cash, after debt $19.35 million cash sweep, used $2.35 million equity cash flow minus $1.4 million. Year 2 senior interest $8.78 million sub-debt interest, $6.4 million mezzanine interest, $2.4 million cash after debt, $20.72 million cash sweep, used $5.94 million equity cash flow $2.60 million. Year 3 senior interest $4.95 million sub-debt interest, $6.4 million mezzanine interest, $2.4 million cash after debt, $22.14 million cash sweep used $11.23 million equity cash flow, minus $0.44 million. Year 4 senior interest $1.38 million sub-debt interest, $6.4 million mezzanine interest, $2.4 million cash after debt, $23.69 million cash sweep, use $17.38 million equity cash flow $1.53 million. Year 5 senior interest 0 sub-debt interest, $6.4 million mezzanine interest, $2.4 million cash after debt, $25.24 million cash sweep used 0 equity cash flow $25.24 million. Step 4 Exit Value. EBITDA in year 5 $45.9 million. Exit enterprise value $45.9 million times 8 equals $367.2 million. All debt at exit is 0 senior paid off sub-debt, and mezzanine still exists. Subtract outstanding sub-debt $80 million, and mezzanine $20 million equity, proceeds 367.2 minus 80 minus 20 equals $267.2 million. Step 5 Full equity cash flow timeline. Year 0 minus $100 million initial equity years 1 through 5 cash flows from step 3 plus or minus year 5 exit, plus $267.2 million. Step 6 IRR and MOM. Cash flow vector minus 100, minus 1.4 2.60, minus 0.44 1.53, 292.44 includes the year 5 cash flow 25.24 million plus exit, proceeds 267.2 million using the IRR formula or Excel IRR approximately 24.3%. Multiple of money equals minus 1.4 plus 2.60, minus 0.44 plus 1.53, plus 292.44 divided by 100 equals 2.96 times. Thus the sponsor almost triples the money in 5 years, with a strong 24% annual return. Step 7 Sensitivity Snapshots. If exit multiple falls to 7 times equity proceeds, 45.9 times 7 minus 100 equals 220.3 million, leads to IRR approximately 19.1%. If senior debt is raised to 4 times EBITDA, that is $320 million equity injection falls to $80 million, leads to multiple of money, improves to 3.5 times. But IRR drops to approximately 22% because more cash is tied up in debt service. Takeaway: the example walks through every piece: building the operating forecast, constructing the debt schedule with amortization and cash sweep, calculating equity cash flows, modeling the exit, and finally deriving IRR and MOM. The same steps are replicated with different assumptions for real deals. If a company's EBITDA grows at 6% year over year, and the senior debt ratio is 4.0 times EBITDA, what is the maximum senior debt amount in year 3? Forgetting to recalculate EBITDA each year before applying the multiple. Compute EBITDA a year 1, year 2, year 3, then multiply year 3 EBITDA by 4.0. Explain why a cash sweep improves equity IRR even though it reduces free cash flow available to equity in the short term. Assuming cash sweep is always negative for equity, it forces early debt repayment, lowering interest expense in later years, which lifts later equity cash flows and overall IRR. Given an exit multiple of 8 times and a WACC of 10%, which valuation method will always give a higher exit value? EBITDA a multiple or DCF? Forgotten that DCF depends on growth rate assumption. Not deterministic, compare numerically. The exam expects you to calculate both and pick the larger. In a sensitivity table, the IRR rises when the leverage ratio is increased from 3 times to 5 times EBITDA. Why might this be misleading? Ignoring covenant breach risk and higher default probability. Higher leverage boosts return only if the debt can be serviced, otherwise the deal may fail. Identify 3 error check cells you would include in an LBO model. Debt coverage ratio EBITDA over interest, greater than 2.5 times. Cash balance check, ending cash should never be negative. Balance sheet reconciliation. Total assets equals liabilities plus equity after each year. A sponsor adds a $10 million earn-out contingent on achieving $500 million revenue in year 5. How should this be reflected in the model? Treating earn-out as debts. Model as a conditional cash outflow in year 5, negative equity cash flow, that only triggers if the revenue target is met. Why is the equity cash flow in year 0 always a negative number? Forgetting that the sponsor pays cash to acquire the company. It represents the equity capital outlay. All subsequent cash flows are returns. Calculate the multiple of money if the sponsor invests $120 million and receives $360 million at exit, with no interim cash flows. Multiple of money equals 360 divided by 120 equals 3.0 times. Adding the initial investment to the exit proceeds, double counting. Common pitfalls summary. Mismatched timelines, mixing calendar years with fiscal years. Using EBITDA instead of adjusted EBITDA for debt capacity. Forgetting tax shield on interest when computing free cash flow. Neglecting cash sweep in the debt schedule, leading to overstated ending debt. Incorrect exit timing, applying the exit multiple to the wrong year EBITDA. Not linking worksheets, manual entry breaks model integrity. Study tips. Build a simple 3-year LBO from scratch. The mechanics stay the same. Always cross-check that total sources equals uses at acquisition. Run a what-if on every key driver and verify that IRR moves in the expected direction. Keep a list of covenant formulas and watch the red flag cells. Practice writing short explanations like the ones above. Exam graders